Welcome to the Deep Dive. Today, we're really getting into the weeds with ICICI Prudential Life Insurance Company, Ltd. We'll be looking closely at their Q1 FY26 results and what might be coming down the pike.
Yeah, financial reports can feel pretty dense sometimes, can't they?
Absolutely. It's like a jungle of numbers. So our mission today is simple. Cut through the jargon, pull out the key stuff for you.
Exactly.
We've got a few different updates and figures to walk through, and we'll take them, one by one, make sure it all makes sense.
Right. We're aiming to connect those dots, help you see not just the numbers, but what they actually mean for a company like ICICI Pru.
Okay, let's get straight into it then. Q1 FY26 performance. What jumps out first?
Well, the first thing you notice is kind of a paradox, actually. Their total annualized premium equivalent APE, basically how they measure new sales, it went down.
Down by how much?
By 5% compared to last year. And what makes that stand out is that the rest of the private insurance industry actually grew by about 10.2% in the same period.
Okay. So they're lagging the industry on that front. Was it across the board?
Pretty much. Their retail APE specifically dropped even more sharply, down 9.2% year over year. So volume-wise, things look a bit weak.
Right. But you said there was a paradox.
Yes, because despite that lower volume, their value of new business VNB margin actually improved. It went up to 24.5% in Q1 FY26.
Okay, wait. So VNB margin, that's like the profitability of the new policies they did sell.
Exactly. It was 22.8% in FY25. Now it's 24.5%. So even though they sold fewer policies overall, the policies they are selling are more profitable.
Interesting. So that margin improvement must have helped offset the drop in volume, right?
Precisely. It limited the actual VNB decline to just 3.2% year over year, much less scary than the 5% or 9% drop in APE suggests.
That makes sense. It's about the quality of the sale, not just the quantity. Did they manage costs too?
They did, yeah. Their cost to total premium ratio came down quite nicely. It was 24% in Q1 last year, and it dropped to 21.2% this Q1.
That's a decent improvement. Shows some operational efficiency.
Definitely. And one more positive point. Their assets under management, the AUM, kept growing, up 5.1% year over year, reaching rupees 3,245 billion.
So a real mix there. Lower sales volume, but better margins, better cost control, and growing assets.
Yeah, it's fascinating, isn't it? That tension between the volume drop and the margin improvement. And the cost reduction ties right into that improved margin. It really points towards, strategic moves happening behind the scenes.
Focusing on profitability, maybe?
Seems like it. Prioritizing the type of business they're writing, even if it means sacrificing some top-line growth for now. It's a deliberate choice.
Okay, we've thrown around terms like APE, VNB, AUM. Maybe we should take a step back and quickly define these for everyone. It helps make sense of the numbers, doesn't it?
Absolutely essential. You need the vocabulary to understand the story.
So how does a life insurance company even work, basically?
Well, at its heart, it's pretty straightforward. They collect premiums from policyholders, right? In exchange, they promise to pay out a lump sum, usually upon death or after a set term. The key is they take all those premiums collected over the years and invest them.
To make sure they have the money for future claims.
Exactly. They need that pool of money to grow, often over decades, to meet their long-term promises. That's the core engine.
Got it. So let's break down those terms we mentioned. APE.
Okay, Annualized Premium Equivalent. Think of it as a standard yardstick for new sales. It combines regular annual premiums with a slice, usually 10% of single one-off premiums.
So it levels the playing field between different types of policies.
Precisely. It gives a consistent view of the new business volume they're bringing in.
Okay. And VNB, value of new business.
VNB is all about future profit. It's the present value of all the profits the company expects to make from the new policies sold in a specific period. It's a key profitability metric.
So not just the immediate cash, but the long-term value.
Exactly. And the VNB margin, that's just VNB divided by APE, a percentage that tells you how profitable that new business is. Higher margin means more profitable policies.
Which is what ICICI Pru achieved in Q1.
Right. Now, embedded value, or EV, this one's crucial for valuation.
Okay.
EV represents the present value of future profits expected from all existing policies already on the books, plus the company's net assets. It's like the company's current built-in value from its established customer base.
So even if they stop selling new stuff today, that's the value they'd expect to realize over time.
Basically, yes. It's a more stable measure for these long-term businesses.
And that leads to the PE ratio.
Yep, price to EV. Just like a PE ratio for other stocks, it compares the company's market price to its embedded value. It helps gauge if the stock might be under or overvalued relative to its intrinsic worth.
And a lower PEV might suggest it's potentially undervalued.
Potentially, yes. Or it might reflect lower growth expectations. Context matters.
Okay, and ROE.
Return on embedded value. Similar to return on equity, it measures how effectively the company is growing that EV. Is it generating good returns on its existing value? Higher ROEV means more efficient value creation.
Makes sense. Two more quick ones. Banca channel.
Simple. That's selling insurance through banks, like ICICI Bank selling ICICI Prudential policies in their branches. It's a huge distribution channel for many insurers.
Gotcha. And ULPs.
Unit-linked insurance plans. These are hybrid products. Part premium goes to life cover. The rest gets invested in funds, kind of like mutual funds, so the policy value goes up or down with the market.
Okay, great. Thanks for that breakdown. Understanding those terms definitely puts the Q1 numbers and the strategy into much sharper focus.
Absolutely. Context is everything.
So let's talk more about that strategy. You mentioned product mix shift. What's happening there?
Well, it seems customers are moving away from those market-linked products, the ULIPs we just mentioned, probably due to market volatility,
People getting nervous about investment.
Likely. So they're shifting towards non-linked savings products, things with more guarantees and pure protection policies, like term life insurance.
And is ICICI Pru leaning into that shift?
It seems so, and it's working in some areas. Their non-linked savings APE actually grew by nearly 21% year over year. That's strong growth.
Wow, okay.
And protection APE grew over 15% year over year. Protection now makes up almost 22% of their total APE mix, which is quite significant. Retail protection specifically grew even faster, over 24%.
So they're successfully capitalizing on that customer preference shift towards safety and protection.
Looks like it. It fits perfectly with the higher V&B margin story, too, because protection and non-linked products often carry better margins than, say, ULPs might.
Right, connecting the dots. But didn't you mention annuities were down?
Ah, yes. Annuity APE declined sharply by over 53%. But the company says that's mainly because they had a huge product launch last year, creating a very high base for comparison.
Okay, so maybe not a strategic retreat, just a tough comparison.
That's the explanation given. The main story is definitely the growth in non-linked and protection.
And how are their sales channels performing? You mentioned the banca channel earlier.
Right, distribution is key. They have a pretty diversified mix, which is generally a good thing, reduces risk.
How so?
Well, if you rely too heavily on one channel, like just bank partners or just agents, and that channel hits a rough patch, your whole business suffers. Diversification makes you more resilient.
Makes sense. So how did the channels do in Q1?
The banca channel, selling through banks, saw its APE decline slightly by about 2.1%, but it's still a huge contributor, almost 30% of total APE, and apparently the focus there within the parent bank is shifting towards protection products.
Aligning with the broader strategy. What about other channels?
Well, partnership distribution selling through other partners, maybe non-bank financial companies or brokers, was actually the only channel to show APE growth, up 6.6% year over year.
Interesting. What are they focusing on?
Mostly non-linked savings and protection annuity products, again, fitting the pattern.
And the traditional agency force. Direct sales.
Both saw significant declines. Agency APE was down about 19%, and direct channel APE down 15%. The company links this partly to that high annuity base last year, and also the general shift away from ULPs, which agents often focused on.
So the channels focused on the new preferred products did better, relatively speaking.
Seems that way, yes. And they're also launching new products to support this shift. Things like iProtect Smart Plus, Smart Insurance Plan Plus, and a health rider called IPRU Health Protect Rider were all launched in Q1.
Keeping the pipeline fresh.
Got to. It shows they're adapting to what customers want now. More protection, more health focus, more predictable savings. It's about staying relevant.
Okay, let's pivot to the future then. What are the projections looking like?
Well, analysts expect that strong V&B margin to hold steady around 25% for the next couple of fiscal years, FY26 and FY27.
So continued profitability on new sales. What about the sales volume, the APE?
That's projected to recover. They're forecasting APE growth of about 9% for FY26 and then accelerating to 15% for FY27.
Okay, so the expectation is that the volume dip is temporary and growth will resume alongside those healthy margins.
That seems to be the base case, yes. It paints a picture of, healthy, profitable growth ahead if they can execute.
And the embedded value, that core value measure.
Also projected to grow steadily. Expected to reach around rupees 545 billion by FY26 and over rupees 620 billion by FY27.
Significant growth.
Yeah.
And the return on that value, the ROEV?
Projected to be solid, around 13.9% for FY26 and 14% for FY27. That indicates efficient generation of value from the business.
And what about valuation? You mentioned the PEV ratio earlier.
Right. That ratio is expected to come down, or moderate, as they say, from around 2.0 times EV in FY25, potentially down to 1.7 times in FY26, and maybe 1.5 times in FY27.
So if the value EV is growing, but the price relative to that value PEV is shrinking,
Yeah.
what does that suggest?
It suggests the stock might be becoming more attractively valued. The market price isn't expected to run ahead of the underlying value growth quite as much. For investors, that could signal a better entry point, assuming those projections hold up.
Okay, so bringing this all together, what's the overall investment perspective here, and what are the big watch-outs?
Well, the general view seems constructive. The current market phase is seen by some analysts as a potentially good time to gradually build a position in ICICI Prudential.
Why? What's the rationale?
It comes back to the fundamentals we've discussed. The focus on margins, the expected return to volume growth, that diversified distribution network reducing risk, and a track record of, pretty consistent execution.
And the valuation potentially becoming more reasonable helps too, I guess.
Exactly. The current valuation is seen as a potentially reasonable entry point for someone with a long-term view, offering scope for value creation if things play out as expected. The stock seems kind of well-positioned during this consolidation period.
But there are always risks, right?
Always. It's crucial to keep those in mind. The big ones here. First, performance risk. What if that volume growth doesn't come back as strongly as projected? Or what if the V&B margins slip? That would definitely hurt the outlook.
So execution risk, basically.
Yeah. And second, regulatory risk. The insurance industry is heavily regulated. Any adverse changes, new rules on commissions, product structures, capital requirements could significantly impact growth and profitability for everyone, including ICICI Pru.
That's a sector-wide risk, really.
It is, but always worth remembering. So, the key question for anyone considering this is how you weigh those potential rewards, the stable margins, growth recovery, diversification against those risks, the execution uncertainty, and the ever-present regulatory overhang.
It's quite a complex picture, isn't it?
Yeah.
We've covered a lot, the recent results, the key terms, the strategy shifts, future projections, and the investment angle.
We have. Hopefully it gives you a clearer picture of what's driving the company right now.
Definitely. So a final thought maybe for you, the listener, to ponder. Beyond what we've discussed today, what could be the next big thing? Could it be a major tech innovation in insurance? Or maybe a completely unexpected regulatory shift that fundamentally changes the game for ICICI Prudential and its peers in the years ahead? Something to think about.
Indeed. And just to reiterate, while we've aimed to provide a deep understanding based on the available information, this isn't financial advice.
Absolutely crucial. Before we wrap up, the necessary disclaimer. We are not SEBI-registered financial advisors. If you are thinking about making any investment decisions based on today's discussion or anything else, please consult with a certified financial advisor who understands your specific situation.
Always the best approach.
Thanks for tuning in to The Deep Dive.